A long-term investment, also known as capital market, is held for more than a year and could include stocks, bonds, real estate, infrastructure, cash, etc. A typical example would be one company investing in another without planning on selling its shares. It is significantly different than investing in the short horizon, also known as money market, because a long-term investment may never be sold, while a short-term one will most likely be sold within 1 year. The decision whether to classify an investment as short-term or long-term has a significant impact on how those assets are presented on the balance sheet. Short-term investments are marked to market, which means that each decline in value of the asset is recognized as a loss in the income statement, but increases in value are not recognized as gain until the asset is sold. However, a long-term investment is recorded in the asset side of the balance sheet and does not reflect the fluctuations of the market. Any premium or discount to par value is amortized, resulting in a more stable net income. Let's now discuss some of the advantages of investing long-term. Firstly, as we mentioned before, this means that the investor will not be affected by the short-term risk fluctuations, which means that it makes its return more reliable in the future. Secondly, long-term investors can benefit from a decrease in prices due to higher risk aversion in certain times, meaning when people avoid taking risks, the prices decrease. If a long-term investor keeps its risk aversion constant, then he can take advantage of the temporary lower prices and purchase more assets. This behavior is also known as counter-cyclical, which means that you invest in assets that are currently decreasing in value and sell assets that are performing well. This will allow an investor to capture higher returns once the environment is balanced again. Thirdly, investing in the long horizon gives you the option to invest in illiquid assets, which is impossible in a short-term horizon investment. Now, let's talk about the disadvantages of long-term investments. To begin with, one of the main issues with a long-term portfolio is that an investor needs to always keep enough liquid assets as well, in order to be able to react quickly to an unexpected unfavorable event. Secondly, investors' natural reaction is to sell assets when the economy is bad and expand their investments when the situation gets better. This is also known as pro-cyclical behavior, when your investments move in the same direction as the economy. This makes your portfolio more dependent on external events than on your own investment strategy. As we mentioned before, when investing in the long run, one should consider counter-cyclical behavior. Another issue when it comes to long-term investing is the agency problem. There is a gap between the interest of the asset owner and the agent. Agents are more focused on the short-term wins, which provide them with performance fees. However, the asset owner is not affected by the short-term fluctuations of the market and are aiming at a higher profit when the asset matures. This problem can be solved by defining precise time horizon and performance measures in the agent's contracts, which will align more closely their interest to the interest of the principal.